everyone and welcome back to the channel. In this video, Preston Pysh and James Lavish discuss the pitfalls of trading based on rational market assumptions, highlighting the significant impact of political cycles and central bank interventions on market outcomes. Key historical examples, such as the 1987 crash, the 1998 long-term capital management crisis, and the 2008 financial meltdown, illustrate how interventions have created an expectation of bailouts among large financial entities. The discussion also explores the dominance of the dollar and the eurodollar market, emphasizing how global reliance on the dollar persists despite its devaluation. Finally, the conversation highlights Bitcoin's potential as a superior store of value, especially as fiat currencies continue to debase, positioning Bitcoin as an attractive alternative for preserving wealth.
This is what I'm thinking, is that I'm historically a fucking terrible trader. I don't trade stocks anymore because everything that made sense never worked. And I think in doing the show and talking to people like you, I've realized I'm trading rationality. I should be trading political cycles.
That's not a bad trade.
Because if you're saying the tax receipts are going to be dropping and then corporate earnings are going to be dropping, that would be saying to you, well, I should be selling these shares, and maybe they will, and then that's the time to buy when the blood's on the streets because they're going to pump the money into the market. Is that what you're basically saying?
Pete, I would recharacterize it as you were acting as if we're in free and open markets.
Yes.
When in fact we're nothing of the sort, right? Yeah. And I think that, boy, have I made that mistake for a really long time in my life, like where I thought I was operating in this world where like these antics, these $1 trillion antics weren't happening, and that I was positioning myself as if I was in a free and open market when I wasn't.
Yeah. But let's pull on that thread a little bit, right? So you would think, okay, well, short everything.
Yeah.
Right? Like short everything, right? But you can't, because you have what we saw in 2020, that V recovery because of the money printing. So let's talk through that though. But you go back to when this started. It was in 1987 when the market crashed, Black Monday, right? I wasn't even I was in high school. But I remember this and I remember everybody freaking out, right? But what happened was Greenspan came in, and you remember this from your research, but Greenspan came in and said, we will do everything to make sure that the markets don't collapse. They didn't really do anything, but they said they would, right? So now flash forward. You've got, you flash forward to 1998, right? And long-term capital management, they were putting on these geniuses who actually won Nobel Prize. There were Nobel Prize winners for the economics Nobel Prize, not that, but they won for the Black-Scholes model, the options pricing model. I mean, these guys were smart, right? But they were levered. How much were they levered? They estimate about 100 to 1. So they had $1 billion of capital in their firm, and they had about $100 billion that they could figure out on swaps on something called an interest rate trade. It was they were basically shorting volatility in bonds, right? And so when you had the Russian ruble crisis and bond spreads blew out, they got obliterated. The street started hearing about it, and they blew up in a matter of days, right? So what happened was the head of Goldman, right, was they were in a panic. So I was getting calls from this. I was in the market this time. I was in an arbitrage trading firm, and I had some of the trades on. They were blowing out. Like, what is going on here? And we knew that long term was blowing up. So we were adding to the positions. No, we had capital. We were fine. We weren't levered. But I got a phone call from one of the biggest hedge funds in Texas, and they said, hey, do you guys have any assets at Goldman? And I was like, no, we're not using them as a prime broker. And they said, well, if you have any counterparty risk with them, get out today, because they're going to blow up. This is Goldman. So
they wouldn't let Goldman blow up.
The head of Goldman went to the head of the New York Fed and said, we're going to blow up. We need help. And so they assembled a room full of heads of the banks, and they basically engineered a bailout for Goldman. Okay, so this is where it started. So, well, it started in 1987. Then they put it into effect. They're like, okay, we can make sure that the banking system's okay. Our buddies over at Goldman, we got to make sure that they don't blow up, because it could have taken down the street. We're talking about counterparty and contagion, counterparty risk and contagion that would have spread everywhere, right? So that's where it kind of started. And then you flash forward to 2008, and it was a full-on rescue the entire, banking industry because
And it's been that way ever since.
and it's only to Preston's point. The whole point of this is it's only compounded since, because the market has learned that certain players have learned that they're big enough. They can be irresponsible with their debt loads and this sheer amount of credit they have, and they'll be bailed out. And so that's what the market has learned. And so the rational market would say, short everything. The real market, the insiders, say, oh no, we'll get bailed out.
Well, here's the really crazy part. So everything we've talked about, this is the best G7 currency.
Well, yeah, get up the dollar pound exchange rate.
This is the best one.
No, because this
in
is
the mix.
Yeah, because look at this. This is really super interesting. So I track the dollar pound exchange rate with a lot of interest, because all our contracts are priced in dollars for the podcast. Sure. You know, it doesn't matter which sponsor we have, we price them in dollars because all the companies we deal with in dollars. So I'm in this weird position where a falling pound is really good for me.
Yeah.
And it's a weird one because I kind of don't enjoy it. But if I was talking about this the other day, so one of the first times I came to the US, as 2007, I think it was. It actually hit $2.11 to the pound. I was $2.05 when I was here, but it was $2.11. And now where are we at, Dan?
Well, you see, you know what's happening here.
Yeah, but so what happened was during the crisis of Liz Truss, we nearly hit dollar pound parity. We bounced back. Was it to 131?
Yeah, something like that.
Yeah, and now we've dropped back down to what, 121, 122. But look at the trajectory of here since 1975. It's up and down, but we are constantly weakening against the dollar.
Yeah,
always.
And that's Brent Johnson from Santiago Capital, his dollar milkshake theory, that the dollar is just going to continue swallowing the world whole. And because so many contracts around the world are based in dollars. You know, you have euro dollar market is just massive. I don't know if we can even quantify it.
I have it would be too tangential to our conversation, but a conversation about stable coins and the euro dollar market and why I think it's a really important aspect. But when we look at this, so this comparison for you in the UK is, it's losing value. It's not, but most of the world is dealing with just a catastrophic currency. Most, right? And so when we look at why so many people are using Tether and using stable coins, is because they've all come to the realization, okay, like this is a dollar kind of world. And if I can get access to a stable coin, well, that's my most desirable. By the way, all my bills are denominated in dollars as the performing asset. So like, I don't want to have to become a currency, trader here. I just want to hold dollar stable coins. I don't even need to save them. I need to pay my bill at the end of the week, and I know that's going to preserve my buying power the best. So that's what I want to have. Yeah. And so half the world more has already come to this realization that they need to hold dollars, because the disaster we've talked about is the best performing currency in the world right now for G7. If people are doing business with the US, Europe, or wherever, like, you got to be dealing with dollars.
Any country who can't, a lot of countries around the world that can't issue debt in their own currency because it's devaluing so rapidly, they'll issue it in dollars. But that means they need dollars to pay interest on those. So what we're going to see at some point, and I wrote about this in my newsletter last week or maybe the week before. What we're going to see at some point here, I think in the near future, is you're going to start hearing that the Fed's opening up the swap lines again. To Preston's point, and the point is that why would they open swap lines and just dump dollars around the world? Like, if there's a shortage of dollars, what's a shortage of dollars means? It means that all of these countries need dollars, but they're too expensive, so they can't get them. So what do they have to do? Well, they have to sell their dollar-denominated assets, which are what? U.S. Treasuries, right? Well, the Fed is trying to sell Treasuries. The Fed's going to try to sell trillions of dollars.
So what does that mean for yields?
Right.
If everybody's a seller.
Right. So you can't. So yields will spike. It only makes it more expensive. Then the Treasury's in more of a deficit, and they need to issue more Treasuries. So what do they need to do? They need to get dollars to everybody. So they'll open these swap lines, give them dollar contracts, so they can use those dollars and not sell Treasuries, because they need the Treasury market to remain liquid for who? for the treasury to keep dumping treasuries on the market. So
It's some game.
I think this is, so taking this to Bitcoin, right? I think that scenario with them opening swap lines, pushing more dollars outside the US and into this euro dollar market is actually extremely advantageous for Bitcoin. So here's why. When we go back to the Silicon Valley Bank situation, what happened to Circle and these stable coins that were US based? Everybody was scared as hell, right? Because they were worried that, hey, those are touching the US rails. And if they let Silicon Valley Bank fail, like all of a sudden, like these stablecoin issuers, which they're all centralized, every one of them centralized. Hell, I could make the argument that the turnkey Ethereum / Tron and all those, like the whole thing's just a centralized POS, proof of stake.
But they're centralized even at like the issuer level, like they're centralized at Circle.
They're centralized the whole way
regardless of
down.
where they are.
And you know what? People that are using dollars as a form of payment, like I'm going to hold it for 3 days and I'm paying some bill that I've got to pay. Whatever, that's fine, right? Like it's not a big deal. It's like I don't care how the people want to pay their bills, right? I'm looking at Bitcoin as a savings technology that will eventually migrate towards a payment technology as we merge this legacy world with where we're going. But back to the point on why this Eurodollar market is so important is Tether. Nobody was concerned about Tether failing during the Silicon Valley Bank situation
Because they're offshore.
because they're offshore. They're in the Eurodollar market. So as they continue to flood these dollars through swap lines out into this Eurodollar market, it gets bigger and bigger. And you have stable coins that are outside the US building stablecoin products on top of that. You're getting the entire planet addicted to the dollar. You're getting the entire planet addicted to conducting transactions on their phone. You're teaching them how to basically conduct these transactions, but when it comes to the end game and you're competing with the dollar versus Bitcoin, the dollar is debasing at least 7 to 8%, right? And with enough time, what do you think these people that are getting addicted to the dollar are going to realize, especially as the volatility as it compares to the dollar starts to subside? They're going to realize, oh, I want to hold this thing over here that is appreciating in value by 7 or 8% versus the dollar. And we're just using like past compound annual growth rate. It could go to 15% with all this inflation. Like I have no idea how much the M2 is going to blow out based on all the issues you got. Let's just say it goes to 15%, right? That they're debasing the M2 rate where it's growing. When you're comparing that to Bitcoin, that is a 21 million hard cap, that is going to be immediately manifesting itself in that, whether people want to realize it or not. It is. It's just going back to Greg Fott. It's just math.
Just math.
Right? So I see the Eurodollar as actually being a huge asset to Bitcoin, long-term Bitcoin adoption, because you're getting off the Fed rails and outside of their control, and the bigger it gets. Now, I have concerns about Tether basically dominating that space, and there's only like 15 employees that work at Tether, and like what the stranglehold could be there. I think there needs to be more stablecoin operators that are outside the US jurisdiction that are using those Eurodollars, that Eurodollar market to hold on their treasury. I see this really strange relationship, and we've talked about it on other shows, where like, who is going to buy all this? Are you going to rely on hedge funds that go 500x leverage to buy your treasuries? Or are you going to like rely on somebody that's willing to buy the short duration issuance of this because it's...
Ironically, that's now Tether as well. Like they buy more treasuries than Canada.
It is. It's the relationship that both of them didn't know that they needed to have.
Yeah.
Right?
Yeah.
From this conversation, we learned that traditional trading based on rational market assumptions often falls short due to the significant impact of political cycles and central bank interventions. Historical events such as the 1987 market crash, the 1998 long-term capital management crisis, and the 2008 financial meltdown illustrate how these interventions create an expectation of bailouts, leading to distorted market behavior. We also learned about the enduring dominance of the dollar and the expanding Eurodollar market. Despite the dollar's ongoing devaluation, it remains the most stable and widely used currency for international transactions. The prevalence of stablecoins like Tether, operating outside US regulatory frameworks, further underscores global reliance on the dollar. Lastly, the conversation highlights Bitcoin's potential as a superior store of value. As fiat currencies continue to debase, Bitcoin's fixed supply and growing adoption make it an increasingly attractive alternative for preserving wealth, setting the stage for broader Bitcoin adoption in the future. So, what do you think about this conversation? Do you agree with the arguments presented by Preston and James? Also, did you learn anything new from this interesting conversation? Let us know in the comment section below. If you enjoy this type of content and want to see more, make sure to give this video a like and subscribe to our channel. Until next time, keep learning and keep stacking.